Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything personal finance related. So some days we talk about the equity markets. On others, we talk about your mutual fund strategy. And sometimes, very importantly, we talk about insurance, because if there's one financial product that is consistently missold and that you have complaints about, it is insurance, and that's mostly in the life insurance space. And that's something that policymakers are taking cognizance of. There is an insurance bill that is soon to become a law. And there are certain aspects of the bill that pertain to the mis-selling problem. It's not immediately apparent in the language, but then this is what my bureau chief in New Delhi has pulled through, and this is source-based information, bear that in mind. One of the proposals in the bill empowers the insurance regulator, which is RDAI, to cap agent commissions through regulations. And it also empowers the regulator to tighten oversight on payouts and on disclosures. This is among various things that have been included apparently in this bill. There's also the possibility that the bill allows for the regulator to prescribe limits on any commission and remuneration that is paid out by insurance companies. And there is an ability by the IRDAI to prescribe limits on any reward payable to agents or intermediaries. All of that has to do with how insurance products are sold. To talk about whether this changes things, I'm joined today by Mahavir Chopra, who's the founder of beshak.org. Mahavir, thanks so much for taking the time, and good evening to you. I must say at the start that we've spoken about this often on this program and on others, the need to regulate this, the need for policymakers to step in. Do you think that this curbs the biggest problem in the insurance space currently?
Yes, so if we're talking about the insurance commissions, right, largely.
Yes.
Yeah, so regarding insurance commissions, it's actually a very complex issue. It's not a very simple issue. There are two aspects to it, right? Why are commissions high today? The reasons commissions are high today is because there are two major problems. One is the problem of awareness. People are not aware about insurance and why insurance should be bought. And second is basically about complexity of products. The products are super complicated. When these two things are brought together, it becomes a very complex product, which requires huge amount of effort for an individual advisor to sell, or even an institution to sell the product. And that effort is today getting paid through commissions. Now, if commissions have to be lowered, and that is actually a good thing to do because it actually reduces the problem of mis-selling, products will have to be simplified, and awareness will be the place where insurance industry will have to invest much more than what they do today. So if that is done, it will have to be done as a composite activity where basically not only commissions are brought into, are spread over a period of time, so that basically it reduces the kind of mis-selling that is happening today and reported so many times, so many places. But it also, along with that, solves for awareness as well as basically the complexity of the products. Like if you look at the health insurance product, it is so complex since the last 10 years. Now with the use and file regulation, which allows insurance companies to dynamically change products on a day-to-day basis, it has even become further complex. Like an expert company like us who continuously does analysis and research about insurance also grapples on some days to be able to understand what are the changes that an insurance company is making on products. So
but before we get into some of these aspects, I want to lay the context, right, Mahavir, and you're the best person to do that. So as things stand right now, can you explain the commission structure for some of these insurance products and why it is seen as problematic? It's not just the quantum, it is also the way in which this is split over a period of time, isn't it?
Absolutely. So yeah, that's actually right, meaning let's understand that first. So typically in case of life insurance, commissions are given are completely front-ended. So the commissions, let's say if it's a product like life insurance, it's a savings product, or even it's a term insurance product, the commissions would be in the range of around 30 to 40%. And then from next year onwards, the commissions will drop to, let's say, between 1% and 5%, right? In case of health insurance, the commissions would be basically somewhere around 30%. and then, or let's say between 15 and 30%, and it would drop down to 15% from renewals. So for a person who is basically looking at this from a very short term point of view, who just basically wants to generate a lot of revenue, first year acquisition of customer becomes very, very lucrative, and renewals then do not become lucrative, because of which there are so many people who will just sell without right disclosures to the customer about the products and the features, so that even if they drop off in the next year, it wouldn't matter to them.
So,
right?
but
That's what
why,
basically-
just to ensure that I'm understanding everything correctly, right? So you're talking about a massive percentage of the first year premium, right? You're talking about
Right.
30 to, did you say 50%?
Yeah, it does go to 50% also in certain products.
So 30 to 50% of the first year premium on and this is life insurance policy. Why are you saying that renewal is not preferred? Is the renewal cheaper effectively, therefore?
No, renewals are not cheaper, right? Meaning, it's just that the way the commissions have been designed, the attraction for a distributor is largely acquisition of the customer, right?
Sure.
And because the commissions are tapered down to that level, the focus for a distributor who's largely selling insurance, the direct sales that happens from an insurance company is pretty low compared to what is sold through distributors, is basically towards getting that acquisition from the customer, right? And then basically the persistency that is required. So typically when you're basically selling a life insurance policy, the goal should be that the person is basically invested for at least 5 to 10 years. Like if you look at a good life insurance policy, of course, many life insurance policies are not worth buying. But if you look at a good life insurance policy, it will only start giving you great returns if you complete 10 years. But the way commissions are designed, the policies are typically not sold that way, are basically sold with the push of basically being for the distributor. They are basically front ended, and the focus is first year, and not on basically selling it as a product which is for discipline and basically persistent investments.
And often on this program, Mahavir, we speak about the need to separate insurance and investing, and and that's important, particularly in the context of what you've spoken, because if you compare another investment product, and often you do that with mutual fund units, right? And you do that with equity mutual funds, and you compare that with the investment products that are offered by insurance companies, and you say that at the high point, some of these mutual fund companies will charge you a total expense of 2% of what you invest. And that's pretty high. It actually ranges from anywhere between 15 to 20 basis points, which is 20 paise per 100, all the way up to 2 rupees. And here you're comparing that with a first year cost of 30 to 50 rupees out of 100, which is quite incredible, isn't it?
Absolutely. So that is the issue, meaning wherever the commissions are typically very high, they are products that are designed for monetization for a distributor like a bank, or let's say an NBFC, or let's say a large distributor. They're really sometimes not useful for the customer as much as they are useful actually for a company to basically monetize the customer base that they are, which is a typical sad story that exists today. But there are good products also available in the life insurance space, Alex, where the money, the fund management charges and the allocation charges, which is typically the commissions, are pretty low. And these products are something that can be understood well by customers and bought. So it's not a completely black and white story, where I would say where you do not mix insurance and investments at any point in time. But typically there is a requirement of being aware and buying the right product. Like, meaning there are certain customers today who do not get life insurance. We've spoken in one of our previous talks that we've had, that there are so many customers who do not get term insurance because of their eligibility issues. And there such products do make sense if they are bought right.
Okay, fair enough. Now the question arises, if there is a move to cap agent commissions through the regulations, one would assume that they would look at some of these ratios, right? The question is, does the IRDAI step in at all at this moment? Do any regulations exist, even if they are loose caps?
Yes. So there is an expense management ratio that insurers are required to be maintaining, right? So within that is what an insurance company is supposed to look at, basically charging it on the product. right? So from that perspective, that does exist today, but there is a specific need that has been called out a lot of times, which is basically spreading commissions across board to the tenure of the policy and not making it front-ended. Similarly, something that is going to that has been a success, right? So that's something that basically is being talked about being the something that can be replicated in the insurance space. However, of course, there are issues which need to be resolved before that can be done.
Okay, fair point. Now, a few of the other mentions that have come through is the ability to prescribe limits on any rewards payable to agents or intermediaries. Is this similar to what we've discussed? Because ultimately it falls under the ambit of commissions as well, right? Or is it separate?
No, so yeah, so in India, basically, there are two aspects to how commissions are given to intermediaries. One is basically the commissions which are directly linked to how much the agent or the intermediary has generated as produced for the insurance company. And the second is basically based on various parameters. So the parameter could be, let's say, how good is the kind of customer portfolio that the insurance expert or insurance advisor has brought into place, or how many number of policies have been brought, or based on volume, or based on the number of accounts, customers, premium, and those kind of things are basically brought into picture on over a year, or let's say over a period of time, and then rewards are given to intermediaries so that they solve for other goals that an insurance company has in terms of acquisition of customers.
Okay, so that's fair. And so hopefully a lot of these issues get fixed. Now, a few things have actually been dialed back, and there was a conversation about possibly having an open architecture for insurance agents, which is not being allowed, seemingly. That's what we're hearing. They can't freely sell products of multiple insurers. Do you think that this is a problem?
There are two aspects to this. This actually impacts all the large insurance companies in India. So that's why basically probably it's getting pushed back by all the large insurance companies in India, because the agents are today all basically housed by these insurance companies, and new agents are not getting created on a day-to-day basis, which are really strong and someone who can do a lot of business. So that's one point. The other point is basically creating capabilities, right? So typically, why there is a kind of a restriction for an insurance agent to sell only one insurance company in life, one in general and one in health, is because of training and basically being able to help them understand these policies. Largely, there is a need to solve for skill first, meaning where insurance experts or insurance agents or advisors, whatever you want to call them, are able to grasp products over a span of multiple insurance companies and insurance products, and then be able to cater to them to customers, right? So the capability issue, in my view, is something that needs to be solved. We talk to insurance experts on a day-to-day basis, and we see there is a big gap in terms of the competence of an insurance expert to be able to sell multiple products. So it should be graded, in my view. It should not be given to everybody, because there is definitely a lot of gap in today, the skill set that is available today in the insurance intermediary space.
Okay. Now, we've spoken about some of what is contained in this bill, of course. Among others, there's a conversation about 100% foreign direct investment. But really, from your perspective as a buyer of the insurance policies, what we've spoken about is probably going to be more important. Of course, we'll have to wait for the fine print of the act to come through once it is passed, of course, by Parliament. But Mahavir, thanks so much for talking about the first cut, maybe, if we can call it that, of what is contained in this bill. And hopefully, it's a step in the right direction more than anything else. Thanks so much for taking the time.
Thank you, Alex.